When do you have to report an investment? The rule here is you have to report an investment when the value at the end of the year is more than $1,000, or if you receive more than $200 of income. So 2 questions to ask: how much did I receive? How much income did I get? Okay? Now, the fair market value is going to be fairly easy. That's going to be fairly straightforward. You can use your statement at the end of the year. Whatever that balance was on December 31st, if it's more than $1,000, you have to report it. Now, the income is going to be a little trickier. Okay, we've got 3 rules that we're going to have to keep in mind. All right, here's our first rule. The first rule, and this is an important one, for the Office of Government Ethics purposes, income is considered received when you owe taxes on it. If you don't owe taxes on it, they do not consider you as having received that income. So let's talk about an example. Let's say I own $900 of ABC stock and I hold it in an IRA. Okay. That stock produced $300 of dividends. Okay. Do I have to report it? So it doesn't have to be reported based on the fair market value at the end of the year. We're under $1,000. What about that dividend income? In this case, you do not have to report it. The income in an IRA, those dividends in an IRA, you don't pay taxes on it until you take the money out. So the IRS does not, the Office of Government Ethics, does not consider you as having received that income. So that does not count for financial disclosure requirement purposes. Now, let's change this fact pattern just a little. Same stock, we have $900 of fair market value at the end of the year, and we have $300 of dividends income. But this time, instead of holding it in an IRA, let's assume we hold it in a brokerage account. Do we have to report it? This time, yes, we do. And the reason is because when you receive dividends in a brokerage account, they are taxable when you receive them. So since they're taxable, it's considered as having been received. Therefore, we have to report it in this case. Okay, so now, a logical question here that you might have is, if I don't have to count income in an IRA, but I do have to count income in a brokerage account, shouldn't I just invest in a tax-deferred retirement account, my TSP, an IRA? Should I even have a brokerage account at all? Because if I do have a brokerage account, I'm going to increase my financial disclosure requirements. Yes, you should have a brokerage account. I'm going to give you a short answer, but I do have some articles on our website that I encourage you to check out on this topic about why a brokerage account is important in retirement savings. The short answer is having a brokerage account is going to reduce your tax liability when you get to retirement. It's going to stretch those retirement savings out. So it's a very important part of your component. Most of us don't save in it, but I encourage you to do so. A TSP and a tax-deferred retirement account like an IRA, 401k, 403, all these should be major parts of your retirement savings. Absolutely. They should not be the only part of your retirement savings. Okay, there's more on that on the website. Okay, so now our next rule. We have to aggregate income from ourselves, our spouse, and our dependent children. So we aggregate the income from a single source. So let's give you an example here. Let's say I have a mutual fund, and let's assume it's in a brokerage account, and it paid $150 of dividends. And my dependent child has that same mutual fund in my child's name. Do I have to report that income? So my child also received $150. So individually, we're under the $200 threshold, but you have to combine them together. So collectively, 150 plus 150, $300. We're over the $200 threshold. We have to report. So don't forget to aggregate for yourself, your spouse, and your dependent child from the same source. Okay, there's a related one here. We have to aggregate all types of income. Okay, what does that mean? Let's say a mutual fund paid $150 of dividends, and it also paid $100 of capital gain distributions. Okay, so in case you're wondering what a capital gain distribution is, let's say a mutual fund owns stocks, and they sell some stocks during the year at a gain. Those gains are going to get distributed to you, the investor. Okay, so those gains are getting passed on to you. That's income. So those are capital gain distributions. So the rule for Office of Government Ethics and financial reporting on your 278 is we have to aggregate the dividend plus the capital gains. So 150 plus $100, we're over the $200 threshold. We have to report. Okay.